So in this video, I want to talk to you about the importance of keeping your chart clutter free. Okay. If you notice the chart that I have shown you here, what do we have on this chart? We have price, we have volume, and we have three moving averages and one moving average for volume. That's it. There is nothing else on the chart. But I see a lot of traders using a lot of indicators on their chart. Okay. People use stochastics, people use Bollinger Bands, people use RSI, people use MACD, people use ADX, people use average true range and whatnot. All of that is really not required. You have to focus on price and volume. So make this commitment today that you will keep your chart clutter free so that your mind focuses on the two most important inputs in your trading system, price and volume. Remember, price and volume are two independent variables. Okay. And we need independent variables to do our analysis. Okay. Even moving averages are indicators that depend on the price. So, price and volume are the two things that you need on the chart, and just the moving average just to let us know whether the stock is in uptrend or whether the volume is high, low, or average. That's it. Nothing else is required on the chart. See how clean this chart looks. And by the way, uh, disclaimer as per our SEBI regulations, I am showing you chart which is at least 3 months old. So here we are looking at a chart which is like in October 2023, like 1.5 years ago. Okay. Just wanted to put out that disclaimer that I want to educate only with old charts. Why am I discussing this today? The reason is that if you focus on price and volume, you will get important clues from that stock price movement, okay, which you would otherwise not get if your chart is too cluttered. Okay. So now see, if you look at this, what are the three things that we look for when we look at a base? We look for blue, green, red, right? The blue line should be above the green should be above the red. So the 50-day should be above the 150-day, and the 150-day should be above the 200-day simple moving average. That's the first thing we look for. What is the second thing we look for? We look for minimum 4 points in the base. So let me draw the base for you. From here, we draw the base and we look for minimum 4 points in the base. So let us draw the points. So very, very simple. This is the basics of what I teach. Point 1, point 2, point 3, point 4, point 5, and point 6. So there are 6 points in the base. We need minimum 4 points in the base. That's it. Condition satisfied. What is the third thing that we are looking for? We are looking for minimum 10 candles in the base. Okay. So if you see, if you ignore this candle, start counting from this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. More than 10 candles in the base. So point number 5, the high of this candle becomes our buy point. Okay. So let me remove that. So remember, blue, green, red, 10 candles, 4 points. Blue, green, red, 10 candles, 4 points. Blue, green, red, 10 candles, 4 points. Simple analysis, nothing complicated here, nothing rocket science here. Okay. And preferably, if you have a mother baby candle similar to this, now this I don't think is a mother baby candle because the low of this candle is 191.20. The low of this candle is 191.10. So this is not a mother baby candle. Mother baby means the entire range of this candle from high to low is inside the entire range of the previous candle. The importance of the mother baby candle is it improves the probability of the breakout. I did not say upside breakout. I said improves the probability of a breakout. That breakout could be on upside or downside. For a stage 2 uptrending stock, the probability of breakout on the upside is higher than the probability of breakout on the downside. Very, very simple. So as we can see, the high of this candle, which is 199.80, that's our buy point. Let me mark that. So let us give it yellow color as usual. So that's our yellow line. Okay, I will not draw another yellow line which is 1% above the this yellow line, but that becomes our buying range. In this base, I want to focus your attention on price and volume because those are the two most important things on the chart. Please remove all the indicators from your chart. You don't need anything. I will show you how to focus on price and volume and how to read the little clues that are there in the base. Okay, let me explain that. What are the pros and cons of this base? Every base has got pros and cons. Okay, let us first discuss the pros, the plus points. Then I will discuss the minus points. And we are only looking at price and volume. There is no indicator here. Okay, let's look at the pros. Pro number one. Okay, it is a very tight base. Okay, number two, the buy point is in the blue zone and there are 6 points in the base. 6 is always better than 4, right? And it properly, next advantage is properly displays high volume in during the rally and low volume during the consolidation. Remember, there are 3 steps in our system. One is high volume rally, step 1. Then step 2 is low volume consolidation, and step number 3 is high volume breakout. The step 1 and step 2 is completed as you can see on this base. Okay, so little short tight base. Okay, 6 points in the base, low volume during the consolidation. Okay, getting tighter on the right side. These are the advantages or the plus points of this base. Of course, it is a stage 2 stock. Okay, one more plus point that you might not have noticed about this base is this rising window. Notice here, okay, between this candle and this candle, there is a rising window. So what's the low of that rising window? The low of that rising window is the high of this candle, which is 190.85. So 190.85. 190.85. Okay, so see, I have drawn the support created by the rising window. Remember, rising window becomes support, falling window becomes resistance. So in this case, I have drawn the rising window. The low of the rising window is the high of this candle, which is 190.85. Look how that blue line has become support. Did you notice that? See, you can only notice these little things in the base if you remove all the indicators from your base. Even don't keep more than 3 moving averages. Okay. So if you notice here, that blue line has become support for minimum 3 days. Okay. Day 1, day 2, day 3. That's a good sign. Okay. One negative point about this base is the yellow line, which is the buy point, is in the blue zone, but the gray dotted line, which is the closing price of the latest candle, okay, it is in the red zone. So for the price to break out, it will first have to cross the red zone, enter the blue zone, hit the yellow line, then go into green zone and then come out of the base. That is asking for too much from the stock. For that to happen, we need extraordinarily large volume, which is exactly what happened in this. So have a look at this. I will move it one candle forward. Have a look at this breakout. Okay, in a single candle, the stock closed above the entire base. It went from red zone to blue zone to green zone and to finally close above the base. Now, for that to happen, you need extraordinary volume. Have a look at this volume. This is 44 million shares traded. And by the way, this is ITI stock. Okay. And as per SEBI regulations, I'm using old data. Okay. What's the average volume on that day? The average volume is 6.8 million. Look here. Okay. Here. What's the average volume on that day? 6.8 million. How many shares were traded? 44 million. Okay. So roughly 6 times. Can we say that the actual volume was 6 times or more than, let's say 7 times? Okay. 6.8 multiplied by 7, let's say 7 times more than the average daily volume. The actual volume is more than 7 times the average daily volume. Can we say that? I am just using approximation. Okay. Which means around 6, the actual volume is 600% bigger than the average daily volume. So these are the things that I want you to focus on. If you ignore most other indicators, you will notice on the actual numbers. This is like 600 to 700% more than average daily volume. That's huge. Okay. That is called as a real breakout. For the price to go from red zone to blue zone to green zone to finally close above the base, you need extraordinarily large volume to absorb the entire retail and the overhead supply that is remaining in the stock. And by the way, the stock did not stop here. Since there was extraordinarily large volume, see, more buying came into the stock. The stock actually shot up from the big breakout point. The stock actually shot up like 58% in how many days? 1, 2, 3, 4, 5, 6, 7. In 7 days, the stock gave a 58% return. After that, it began to consolidate. If you notice here, it began to consolidate. But in 7 days, you got a 58% return. Coming back to this. Okay, let me remove this. You see how powerful that breakout was? So let me repeat the pros and cons of the base. The pros are it's a short, tight base on the right side. There is a rising window inside that base, and the rising window has not been broken. There are 6 points in the base. Volume shows a perfect VCP kind of a setup. Okay, these are the positives of the base, which you can only notice if you don't have too many indicators on your chart. You can only notice these little things about the base if your chart is clean. Okay, so please keep your charts clean. Okay, plus there is a high volume breakout. The volume is extraordinarily large. Okay, so and what is the negative about the base? The negative is the yellow line is in the blue zone, but the gray dotted line, which is the closing price of the latest candle, it is in the red zone. That's the only negative point about the base. How do you compensate for that risk? You look for extraordinarily large volume. So by the time the stock opens here, goes down, touches this, okay, by this time, if the volume has already crossed the average daily volume, or the volume has already crossed twice the average daily volume, we can think of taking a trade, because the risk that we are taking is getting compensated by extraordinarily large volume coming into the stock coupled with price action. Okay, let me repeat that statement. The yellow line is in the blue zone. The gray dotted line is in the red zone. That's a risk. Okay, how do you compensate for that risk? We look for two things: price confirmation, volume confirmation. Price confirmation is when the price touches the yellow line, enters your yellow band. Volume confirmation is when you are getting extraordinarily large volume. Now, I cannot mathematically define what is extraordinarily large volume, but if you see things like 6 million shares traded in the first hour of the day, right? The entire previous day's volume or the entire average daily volume is coming in the first hour of the day. That's a sign. It's common sense that the stock will close on extraordinarily high volume, which is like 600, 700% by the time the day closes. Okay. So price confirmation, extraordinary volume confirmation. We could enter with a small position size, or we could also enter with a normal position size. Okay, if we are able to tolerate that risk. What increases our ability to tolerate risk? It is the gains that we have made on our previous 3 to 4 trades. In my previous 3 to 4 trades, if I have made a gain, it allows me to tolerate a bigger risk on this stock. And I could choose to control the risk in another way. I can choose to keep the stop loss at point number 6 when the price hits this line, because by the time the stock opens here, comes down, hits the yellow line, it's already moving upwards. It is not moving down, it is moving upwards. You are buying a rising stock. So there are two ways to control risk. Number one, enter with a small position size. Number two, instead of keeping your stop loss at 8%, move it to point number 6, which would reduce your stop loss to more manageable 2 or 3%. Okay. These are the two ways to reduce or control your risk. So you could either enter with a small position size, or you can enter with a normal position size with a tight stop loss, or you can do both. Okay, depends on how you want to manage your risk. That is discretionary, that is based on your choice. Remember, I always say that in trading there are no rules, there are guidelines. Okay, so different people will approach the same trade in a different way, different way of using position size and managing risk. Some people will manage their risk with a stop loss, some people will manage their risk by adjusting the position size. But when you see something like this happening, to notice that rising window, you have to keep an eye on what is happening inside the base. You have to concentrate on the price, basically. That's what I'm trying to say. And to concentrate on price and volume action, you have to keep your chart clutter free. Okay, only then you can capture such kind of breakouts. Okay, nice run over a period of 1, 2, 3, 4, 5, 6, 7 days, 58% return. What more can you ask for from a stock? So, one thing that SEBI has done nicely is that they're forcing us to only educate students with the help of old charts. So, I'm showing you old breakouts. When actual breakouts happen, this is what happens in the stock. Huge amount of demand comes in, and we should be ready with our analysis. Okay, we should be ready to understand price and volume action inside the base. It gives us very important clues. Okay, so please keep your chart clutter free. Thank you so much.